Let's welcome in Drew Pettit, Director, US Equity Strategy, ETF Analysis and Strategy Research at Citi, who is now with us on the program. Drew, great to have you back on the program. Thank you very much for your time. So every week there is a new one, it seems, a new crisis that is, but the market kind of moves on. And it has, in a way, moved on with kind of limited impact, even though oil prices have moved about 12-13% from last Thursday. I mean, other macro indicators have not really moved. Look at the dollar index or the US bond yields, etc. What do you make of it, and what is the market pricing in?
Yeah, look, so first off, thank you all for having me. Great to be back. And yes, you're right. It's been a revolving door of news flow here. And markets, honestly, a little bit, let's call them insensitive to kind of the human issues that are going on right now. Yeah, look, to us on the macro front, you really have to watch oil. That's what we're all taking our cue from right now when it comes to how we think about equity markets. Yes, it's up 10, 12% from last week, but you got to remember the base it's coming off of. We're talking about a 6 handle on Brent last week. Now we're kind of into the mid 70s as it's kind of cooled off in the last day or so. So look, to us, when we're trying to think about this fundamentally, being a little bit cold and calculated about this, if you see pressure in oil, if you see pressure in commodities, that leads to input cost pressure on U.S. businesses. That's when you would see pressure on U.S. equity markets. Right now, again, like you said, relatively well contained. So busy news week, but actually boring market week.
Busy news week, but boring market week. And, what do you make of that, Drew? Is it at some level a little bit of complacency, or is it just market wisdom that at some point a deal gets done and this will remain contained? Though, I mean, crude prices flared up again last night, so no one really knows.
Yeah, look, so some complacency maybe is starting to creep back in. We've watched our sentiment gauge for the past few weeks start to inch higher and higher and higher, but it's not at that point of euphoria where we were at the beginning of the year. So again, like just putting context of where we are today versus where we were, end of December, beginning of the year, sentiment is down a little bit. Index levels are down a touch. A lot of good news is still priced in. But right now, the macro front, whether it's rates, oil, commodity prices, and the dollar, it's not putting any added pressure on us that we didn't feel a month or so ago. So to some extent, yeah, the market's doing a reasonable job of kind of looking through a little bit of the noise, but it is pricing in a relatively benign outcome, like you mentioned.
Hi, Drew. Good morning. Good to see you. What about your preference for equities? You continue to like Europe and Japan, I believe, and emerging markets, you're not too convinced out there. But my question to you is, how do you approach global equities? What's your top bet? And from the emerging markets, though you seem to be a relatively underweight on emerging markets, is India top of the pack?
Yeah, so we'll go broad and work our way back in here. So look, we're neutral on the U.S. Again, we're talking about good fundamental stories, but a lot of good priced in there. So we'll kind of start neutral there. If you want growth exposure, if you want secular trend exposure, you definitely want exposure to U.S. markets. The overweights, Europe, for bottoming earnings revisions and cheaper valuations there. Japan, again, some strength on the industrial side, even kind of before we got into this tariff mess. So you have some earnings momentum there. On the EM side, there could be some pressure, but what we want to own in EM, again, following our global strategist playbook here, India is at the top of the list because you have pretty good underlying economic trends. You're relatively insulated from trade, and you have a relatively good quality market. Outside of that, we're talking about names like South Africa, Chile, and Poland, who are all seeing inflections in EPS and relatively solid earnings and fundamental growth there.
Okay. All right. By the way, Drew, just one last question. Next week, there is that NATO summit, right? Which I think is going to put the focus back on, defense spending, which is the big sort of constant theme from market perspective as well. I mean, for example, defense stocks here in India have done very well. Defense stocks in Korea have done even better. In Europe, they've rallied hard. What is your sense? I mean, will there be Will that once again send a signal that around the world, countries will spend more and more as US kind of sort of vacates that space as as the global policeman, as someone put it?
Yeah, it's funny. Like just pulling us back to the U.S., where my strength is, at least from a discussion perspective. Look, they have moved a lot. Industrials are the best performing sector year to date. That's where a ton of the defense names live. But and the big but here is just how much growth are you going to get going forward from this? We're talking about defense spending budgets that may increase from kind of flattish to up 2, 3, 4, 5%. We get that the trend is inflecting. But to us, the real kind of defensive trade in the world right now is to add some growth names. While we're thinking about what governments might spend, where companies are going to spend more is on productivity, efficiency, and tech enhancement. So I think anytime you get pullbacks in the mega cap names and in the US indices, you want to buy into the growth stories that have more of a secular trend that we think feeds through to productivity, which all businesses need right now.
All right. Drew, we'll leave it there. Thank you very much. So not industrials, capital goods, but growth names, essentially, is what Drew is very much focused on.